Are you not sure what to make of Mother Market? Right now, it's at near all-time highs, and if you've been invested, you're feeling pretty good. But beneath the surface, some of the most reliable warning signs in financial history are flashing bright red. We are at a historic crossroads, facing a fundamental conflict. On one side, the promise of a technological revolution driven by artificial intelligence, one that could create trillions in new wealth. On the other, the sobering math of valuation metrics that have only been this high right before devastating market crashes like 1929 and the dot-com bust of 2000. So, which is it? A bubble about to burst or the dawn of a new golden age? In the next few minutes, we're going to break down the evidence and give you a clear, data-driven forecast for the next 5 and 10 years. Stick around because what you're about to hear could change the way you think about your money. First, let's talk about the elephant in the room, price. Are stocks expensive? The answer is a resounding yes. This is the Shiller price to earnings ratio, one of the most respected valuation tools ever created. Think of it as a way to measure how expensive the market is compared to its real long-term earning power. The historical average is around 17. Today, it's hovering near a staggering 38. That number has only been surpassed 3 times, right before the 1929 crash, at the peak of the 1999 dot-com bubble, and for a brief moment in 2021. Every single time valuations got this stretched, the market delivered poor or even negative returns over the next decade. And it's not just one metric. The famous Buffett Indicator, which compares the total stock market value to the size of the economy, is also screaming overvalued. Worse yet, for the first time in years, the basic logic of investing is broken. You can now get a higher guaranteed return from a government bond than the earnings yield from the stock market. The extra reward you're supposed to get for taking the risk of owning stocks has vanished. Add in slowing economic growth, with the CBO forecasting GDP to cool to under 2%, and a minefield of geopolitical risks like the ongoing trade wars with China, and the case for a major correction looks incredibly strong. So, with all those warning signs, why isn't everyone running for the hills? Because there's another side to this story, a powerful narrative about 3 unstoppable forces that could reshape our world. First, the AI revolution. This isn't just about chatbots. Generative AI is a game-changing technology, like the internet or electricity. It has the potential to unleash a massive productivity boom across every single industry, from banking to manufacturing. Some analysts believe AI could add up to $13 trillion to global GDP by 2030. Second, the biotechnology revolution. Thanks to an aging population and incredible breakthroughs in gene editing and drug discovery, the biotech market is projected to grow from $1.7 trillion to over $5 trillion in the next decade. And third, the energy transition. The global shift to clean energy requires a mind-boggling amount of investment. We're talking up to $60 trillion by 2050. That's a tidal wave of capital that will create entirely new industries and investment opportunities. The bulls are betting that the profits from these 3 revolutions will be so immense that they will eventually justify today's sky-high prices. So who wins this battle? The scary math of today or the incredible promise of tomorrow? Here is my synthesized opinion, based on all the evidence. For the next 5 years, the bears have the upper hand. The headwinds of extreme valuations, slowing growth, and policy uncertainty are immediate and powerful. I expect a period of high volatility and low returns. That could mean a significant market correction, or a long, frustrating period where the market goes nowhere. My forecast for the S&P 500's average annual return over the next 5 years is in the low single digits, somewhere between 0% and 4%. But over the next 10 years, the picture gets brighter. The long-term structural trends, AI, biotech, and clean energy, will have time to mature and create real, tangible economic value. However, the high price we're starting from will act as a persistent drag. We are not going back to the double-digit returns we got used to. My 10-year forecast is for annualized returns in the mid-single digits, likely between 5% and 7%. This will be a market where picking the right sectors and companies, the true innovators, will matter far more than just buying an index fund. So what does this all mean for you? It means it's time to be realistic. Temper your expectations, stay disciplined through the volatility that is almost certainly coming, and focus on owning high-quality, profitable companies that are poised to win in this new era. If you found this breakdown valuable, do me a favor and hit that like button, subscribe to the channel, and ring that bell so you don't miss our next deep dive. Thanks for watching.